Welcome, everyone, to another episode of Financial 15, the show where Kevin and I try to provide some financial knowledge, something we hope you could use in your financial life and improvement. And we do all of that in 15 minutes or less. And today we're talking about RRSPs, Registered Retirement Savings Plans. We get lots of questions about RRSPs. We all know we get that tax deduction up front, but eventually you have to pay the money back. So are they really worth it? We're going to get into that today, so you're going to want to stick around.
Yeah, definitely. This is one of the questions that is one of the most asked all the time because people are never too sure. Now, if you want to find out more information about it, please check out our website at www.beckerorr.com or our YouTube channel or Facebook page.
Absolutely. Be sure to like, subscribe, share, all that good stuff. Lots of free content out there. So let's dive into this question. Are RRSPs really worth it? Before we can answer it, we have to do a quick background here, a little explanation of what is an RRSP. You can see on the screen there are a couple of points. There is no minimum age. Anyone with a social insurance number that files a tax return in Canada has earned income. They can add to an RRSP. Earned income is a key item there. Pension money, money from dividends, distributions, interest income, that does not qualify for earned income. Think of earned income, money coming from a job. That would be earned income. And there's a maximum age, so no minimum age, but there is a cap. You cannot contribute to an RRSP after the age of 71. There is a certain amount of room that you're permitted based on your income. There's a formula to it, and you can see how much RRSP room you have available after you file your tax return. You get a notice of assessment. It's right there on the notice of assessment. If you don't use the full room in 1 year, it carries forward. You don't lose it. It keeps going. And there's a few more points we'll quickly touch on here, Kevin.
Yeah, definitely. I mean, some of the stuff is money that you contribute does create a tax deduction immediately. So as we say, you get the deduction up front, but sooner or later, it's going to come due down the end of the line. Now, money inside the RRSP also grows tax-free. That's one of the big advantages to doing it, is that unlike a non-registered account where you're constantly being taxed on it every year if there's dividends or capital gains, if you cashed out, this grows tax-free until you start to take the money out, and we don't have to worry about it till then. Now, any withdrawals that you make become fully taxable. So as opposed to the tax advantages of dividends or capital gains or return of capital, there isn't any of that. It is listed as full income when you take it out. And you can contribute to the RRSP for the first 60 days of the new year for the prior year's return. Hence why January, February, usually up to March 1st, are considered RRSP season to get all those last minute deductions in so that you can claim them on the previous year's taxes. That's the basics of what the RRSPs are. Now, we've got more important stuff going forward. What is one of the main points we have to look at, Clint?
Absolutely. We got the basics out of the way. Now we have to answer that question. Are RRSPs really worth it? And to do that, we have to dig into taxes, specifically marginal tax rates. Now, what I have on the screen there is for the province of Manitoba. It's the federal and the provincial combined. So it sees your marginal income tax rates for 2021. If you're from another province, simply go to taxtips.ca. You can see the full URL on the screen there, completely free. You can find your provincial rates, your federal rates, and you can get your marginal tax rates as well. But we're going to use the Manitoba ones because we live in Manitoba, so it's a good example. When you put the money in, you save at your marginal income tax rate. So ideally, you want to contribute when you're in a high rate, so you get lots of savings. And then if you're going to take the money out down the road, hopefully you take it out at a low rate. Now, that just makes sense. You save when you have more tax to save, and you pay it back at a lower rate. We'll use a quick example here. So if I earn, say, $25,000 and I contribute $2,000 to my RRSP, I'm going to be at the marginal tax rate at 25.8%. That means my $2,000 contribution will get me $516 of savings off my taxes. Now, if my wife Jody earns $75,000 and she contributes the same $2,000 to her RRSP, because she's in a higher tax bracket at 37.9%, she's going to see $758 of savings on her tax return. So you can see the benefit. The larger the income, the more benefit to that RRSP contribution. So it makes sense. Contribute when you're in a high bracket, take it out, pay it back when you're in a low bracket. That works to your favor. The catch, however, Kevin, here is we don't know what our tax rate's going to be in the future. If you could tell me 10 years from now what my tax rate's going to be, well, then I would know for certain how I can put money in and when I can take money out. So it's not always that simple. So we have a few guiding principles that help us determine when an RRSP contribution makes sense. The first one here, Kevin, is if there's a jump in your income.
Yeah, temporary income increase is one of the ones to definitely take a look at. Now, this could come from a variety of different options. You could get a large bonus at work for 1 year based on what you've done. You could have sold a cottage, or you could have sold a vacation property over the course of the year, at which point you have a large capital gain now that's going to be added into your income for the year. Now, this is going to spike it. So if you get that sort of a spike going forward, you want to try and eliminate as much of that gain as you possibly can. If you don't have the capital losses in regard to a cottage or a property, then you are going to have to start looking at something along the lines of an RSP contribution. Now, if you make that RSP contribution, that's going to lower your tax that you have to pay, as Clint mentioned, based on what your marginal tax rate is, depending on where you live. So these are some of the big factors that you have to look at for temporary incomes going forward as to what's the best way to try and minimize what I can do. And you do want to try and lower it as best you can if you're in a higher tax bracket. As we mentioned, if it's still a lower scenario, it's not as big a deal. So temporary income increases are definitely one that you have to take a look at for the RSP and making sure that it's worth it there. What's another one we have there, Clint?
Yeah, so the temporary income increase, the second one here is if in general you're in a high income tax bracket, it would make sense to look at an RSP. You might think, well, I don't know what my income is going to be in 5 years from now, 6 years from now, maybe it'll be higher. That's possible. But if you're in a high bracket, it makes sense to cash in on some of those tax savings to your advantage. Now, what do we qualify as high? Well, we have to draw a line in the sand somewhere. And for us, we often use a guiding rule of 35% of a marginal tax rate. So if you're in an income bracket where your marginal rate is 35%, we'll classify that as a high income tax rate, and an RSP contribution starts to make some sense. Now, I'll pull up a table here, and this is by province. These are 2021 numbers, both combined federal and provincial marginal tax rates. And we've looked at the income level required in every province to get your marginal tax rate over that 35% threshold, what we are using as our guiding number. So you can see the level of income where that RSP starts to make sense in our opinion. So Kevin, someone's got income, let's say they're in Manitoba, they got $75,000 of income. They're certainly in that bracket. Makes sense to do an RSP contribution. How much would you suggest they put into their RRSP?
Well, definitely what you want to do, as we mentioned on rule of thumb, is that you want to take it down one bracket if you can. And that's the biggest one. So as we use Manitoba, if somebody had made $80,000 over the course of the year, chances are that you want to bring it down under that 72,886. So if you made sort of an $8,000 contribution, now all of a sudden you're getting 37,900 back based on the marginal tax rate. And now your taxes aren't going to be paying higher than the 33.25% that's there. So that's a big factor to look at. The other one is, as you've mentioned, what your RSP contribution room is for the year. So if you had made 98,000, but you only have the 27,000 plus for the 2020 tax year, you can't bring it all the way down, but you can bring the majority of that down so that you're not paying as much tax. And remember, these are progressive rates. So if you make 75,000 over the course of the year after your RSP contribution, it's only the money between 72,886 and 75 that is actually paying tax at that 37.9%. Everything else is done on a progressive basis down there. So yeah, we want to make sure that we try and make as much to try and bring you down that one tax bracket. And as we say, it's not that you don't want to make contributions on lower amounts, but we usually use that 35% as a general guideline to try and bring your taxes down below that level, just because that seems to be one of the sweet spots going forward. I don't think there's anything else beyond that that we have to look at for how we want to contribute to the RSP.
Those are the key factors there. And again, as a recap, the whole goal here, if we knew our future tax rate with certainty, it'd be easy. We'd simply contribute, we're in a high tax rate, and then we take it out in a low tax rate. So we take it out, they're going to tax us. We want to pay the tax when we're in a low rate. We want to get the advantage and the savings when we're at a high rate. However, since we don't know that future number, we have to use a few guides to try to make the best decision we can to make sure we get full value for an RSP. So if you're in a high bracket, we're using 35% marginal income and above as our threshold there, and makes some sense to make that contribution. As Kevin mentioned earlier, if you get a temporary bump in your income from a land sale, a payout, whatever the case may be, RSP is certainly worthwhile. In other scenarios, it might not be the best fit. Maybe there's a better option for you, but those are a few tips to how to determine whether or not an RSP is going to be worth it for you. Any parting comments, Kevin? Anything else you want to add?
Yeah, no, the only thing that I would add on this point is that we do have a article on this. It is on our website at beckerorr.com. You can order it from us if you want, or we'll send it out from there. You can check out this video again at the website or on YouTube or Facebook. So by all means, remember, any questions that you have, you can easily find us there, and you can chat with Clinton and Kevin, and then we'd be more than happy to answer any questions on this or any other topics that you come up with. that's the final points that I have. Clint, you have anything to add?
I think you wrapped it up rather well. So I appreciate everyone watching. Stay tuned. We'll be back again next week with another video. Until then, take care.